All right, let's just dive right into this explainer with a scenario. A terrifying scenario, honestly, that absolutely every investor out there fears. So picture this. You wake up, pour your morning coffee, check your portfolio on your phone, and your stomach just instantly drops. One of your biggest, supposedly most reliable holdings has literally plummeted 50% in value overnight. Panic sets in, right? You're scrambling, frantically searching financial news sites for, I don't know, a massive scandal, an industry collapse, or a broader market crash, but you find absolutely nothing. The market is completely calm, the company hasn't issued a single piece of bad news. But then, you look a little bit closer at your account balance, and you realize, wait, you haven't actually lost a single dime. Your original 1,000 shares, they simply doubled to 2,000. What you've just experienced is what the financial world calls a bonus issue. Today's explainer is going to map out exactly how this invisible engine room of capitalism actually works. We're going to cover the engine room of finance, defining the action, why companies take action, 3 types of events, the market impact, and finally, the life cycle. Let's get to it. Section 1, the engine room of finance. So let's start with the foundation of these sudden market shifts. Look, the difference between an amateur investor and a true professional isn't just about, picking the right stocks. It's really about understanding the underlying machinery. These sudden shifts, like that bonus issue we just talked about, they're known as corporate actions. And understanding them, that's exactly what separates the folks who are merely along for the ride from the pros who actually grasp the high-stakes operational machinery of the global financial world. Moving on to Section 2, defining a corporate action. So, what is actually happening behind the scenes when a company decides to alter its own DNA? Well, technically speaking, a corporate action is an event, usually instigated by an issuer, that affects a position held in a security. I know, that sounds like a bunch of heavy financial jargon, right? Let's break that down. This dynamic right here brilliantly illustrates the 2 sides of this massive transaction. On one side, you have the security issuer. That's the company itself. They're the ones instigating the event because they want to change their corporate structure. And on the exact opposite side is you. Whether you're a retail investor just checking an app on your phone, a massive hedge fund, or a global bank managing a massive trading book, you are simply classified as a position holder. You hold the security, and because of that, you are automatically a participant in whatever event they throw at you. Which brings us to Section 3, why companies take action. What actually drives an issuer to wake up and instigate these massive structural changes in the first place? Well, it essentially boils down to 3 strategic aims. Think of it as a pie of corporate motivation: distributing income, raising capital, or restructuring. Every single corporate action out there, no matter how complex or weird it seems, fits neatly into one of these strategic goals. Now, the most common aim, and let's be honest, the one we investors generally love the most, is distributing income. When a company actually turns a solid profit, they often want to reward the people holding their securities. So they do this by distributing profits out as dividends to their shareholders, or by paying interest out as coupons to their bondholders. Everybody loves payday, right? The other 2 motivations are a bit more structural. Let's say a company needs to grow aggressively, or maybe they need to pay down a mountain of debt. In that case, they'll focus on raising capital. They might launch a rights issue, which basically offers existing shareholders the chance to buy more shares at a really steep discount. Alternatively, if a company wants to make its stock more attractive, or maybe increase liquidity, they'll focus on restructuring. This is exactly where we see things like share splits to change the quantity of issued capital, or share buybacks to consolidate value. All right, Section 4, 3 types of events. So how do the people working behind the scenes actually classify these hundreds of different complex events to manage their risk? Well, they organize them into 3 distinct buckets. First up, we have benefits. These actively increase your position without altering the underlying security. Think of those cash dividends or that bonus issue we talked about at the very beginning. Second, we have reorganizations. These literally reshape your holding. Like in a merger, you might actually have to trade your old shares in for entirely new ones with a completely different value. And third, we have issuer notices. Now, these don't change your account balance at all. They're purely informational. They basically give you a voice, like sending a notification for an annual general meeting where you can cast a proxy vote.
Moving on to Section 5, the market impact.
Now, what's really fascinating here is that these events absolutely do not happen in a vacuum. They actively move the needle on the entire global market. Just look at this contrast. For the issuer, an action fundamentally alters their balance sheet. It literally shifts the numbers around, maybe turning debt into equity or reducing their overall cash reserves. But for you, the investor, on the other side, it might completely change the cost basis of your portfolio or provide an immediate, tangible cash infusion right into your account. And the market itself, it reacts incredibly logically to this shifting of weight. For example, when a stock goes ex-dividend, its price typically drops. Now, it doesn't drop because the company is suddenly doing terribly. No, it drops by the exact mathematical value of the cash benefit that was just detached from the share. The market is simply repricing the security because, well, the right to that specific cash payout no longer belongs to whoever buys the stock next. It's just pure math.
Finally, Section 6, the corporate action lifecycle.
Because these actions literally adjust market prices in an instant, the stakes for getting the underlying math right are, frankly, astronomical. In fact, corporate actions are widely regarded as the most specialized and high-risk area of global back-office operations. A single missed deadline, a misinterpreted notice, or a simple manual calculation error creates what the industry calls severe replacement risk. If a massive bank gets your position wrong during, say, a major merger, it can instantly mean millions of dollars in losses just to make you whole again. So to prevent those kinds of financial catastrophes, banks and institutions rely on a highly rigorous, systematic process known as the generic corporate action life cycle. It involves 3 uncompromising steps. First, they meticulously capture the event entitlements from the issuer. Second, they clean the data, meaning they cross-reference multiple data sources to ensure absolute bulletproof accuracy. And third, they calculate, literally down to the fraction of a cent, exactly what is owed to every single position holder on their books. So the most crucial point I want to leave you with today is this. We've just seen how these massive structural shifts operate entirely behind the scenes, instantly turning debt into equity or magically having stock prices overnight. But if a single, tiny calculation error in that back-office lifecycle can cost institutions millions of dollars in a heartbeat, just how safe is your personal portfolio from the invisible machinery running capitalism?